Hey everyone, thanks for joining me today. My name's Matt, and what I wanted to do today is something a little different, something I haven't done on my channel before, but I wanted to show all of you how I research stocks for my Watchlist Wednesday videos and other videos. I've seen a lot of other videos out there where people explain their approach towards researching stocks, and I just feel like my approach is a little different, as is everybody's. Since we're basically trying to make an educated guess towards the future, there's a lot of ways that we can go about this, so I just wanted to share with all of you my approach. Just bear in mind throughout this is not advice, so we're not taking this as advice. Also, I just gotta say, like this video, 5-cent donation for charity, subscribe, 10-cent donation for charity. Now, the company we'll be taking a look at today here is Autodesk, and I chose Autodesk really for two reasons. The first one being, it's a company that I hear talked about a lot on the finance podcast that I listen to, but it's not really a company that I know a whole lot about. So I thought that'd be a good place to show you how I approach companies where I really have no knowledge on what this company is, does, and it's a little embarrassing to admit because I know this is a very popular company. Also, I know that they reported earnings yesterday, so I think that would be a good time to take a look at this company to see how those earnings reports went. So I have no script written for this. It's going to be all off the cuff, but what I'll do is I'll bring you over to my computer screen. You're going to get a nice side shot of me through the majority of this video, but just showing you kind of start to finish at a high level my approach towards looking at these stocks. So let me switch over to my computer screen. That I like to start with here is by getting my caffeine ready because admittedly, unless you're like me, it's probably not the most exciting process. I enjoy doing this stuff, but I can get a little sleepy as I go through it. So generally, the first place I really start with these companies when I am not familiar with them is I just do a quick Google search for them and see what the Wikipedia description is. As we see here, Autodesk Inc. is an American multinational corporation that makes software products and services for the architecture, engineering, construction, manufacturing, media, education, and entertainment industries. Sounds good enough. Now, let me say, I have done a little research so far just so this video wasn't completely off the rails. But admittedly, I really thought Autodesk was just a 3D printing company, and I was proven wrong. So what I do next after I kind of see that description is just go to their website. Now also too, with this being a research thing, I don't fully care too much about like a lot of these news articles unless it's something that directly impacts the company, like a merger, acquisition, something along those lines. But what I already see here is something that does catch my interest. And I hope you could see my mouse, that we have subscribe for 3 years, get 10% off. Purchase. What was that? All right, let me just head back there. I didn't know I couldn't click on that. So purchase with Autodesk financing and enjoy a 30 day. Okay, that's not as important. But that's actually encouraging for me to see right off the bat is subscribe for 3 years to get just a 10% discount and then purchase with Autodesk financing. The reason why that's important is if you can get somebody locked in for 3 years, it's going to be 3 years at least of guaranteed revenue, hopefully, which is a good thing to see. And purchase with Autodesk financing, I'm assuming that means that they will probably have some kind of interest tied to that, which is just another way for them to get that revenue going into their pockets. Now let's take a look here though at, I didn't want financing. All right, so after a little clicking around, I was able to find all of their product lists. So they have 82 products, and these are not cheap. So far, the cheapest I'm seeing is $440 a year. I'm sure each of these have their own different purpose, but it's good for me to see at least multiple different products or services that they offer, since that way it's more ways for them to create revenue and not just being a one-trick show. This already slightly reminds me a little bit of Adobe in the fact that Adobe has multiple different products that not everybody needs, but people do utilize a lot of their different systems. Maybe use Adobe Premiere, Photoshop, and After Effects for all of your editing needs. But it looks like they do a lot here with 3D gaming development. I see a few things talking about CAD, which I believe stands for Computer Aided Design. All I know is that I know architects use CAD a lot with their designs, and it's a pretty cool system. So I'm assuming that this is probably where architects get their system software, at least this is one resource for them when they build out layouts of buildings, do like the 3D modeling walkthrough and all that, which I always find that stuff to be really cool. So I guess that this is the supplier of that. And let's just see here. What is Autodesk used for? So kind of quickly taking a look at what they service here, it looks like they actually service a lot of different industries, And from what I'm seeing, it actually seems to be some of those industries that are growing rather quickly. Things like video games, visual designing, or like I mentioned earlier, 3D modeling for architects. I have a general idea now what this company does. I think I have a good enough understanding just to see maybe who their competition is and whatnot. I don't like to spend too much time on this because you can really get caught deep in the weeds with this kind of stuff. And I'd rather just get a high-level overview on what this company does and then look into their numbers, earnings reports, all of that fun stuff, add them to a watch list. And as I do more research, that's when I tend to learn more about the companies. I'm not going to show it here, but I have really bad ADD, so reading through a bunch of stuff is just not really my style. What I will do sometimes, though, is go to YouTube, see if they have a YouTube page, and just see what the company has to say about themselves or show some of their products or services in use. But what I am interested here is in their earnings report. And this is something we could pull right from their website, and I like to get the investor presentation sometimes just to see what numbers they're really focusing on. Now, on any publicly traded company, you should be able at the bottom to be able to find this investor relations tab. Might just say investors or IR or something like that. That's always going to be where you go for like earnings reports, presentations, things along those lines. So this, what I clicked on, brought us basically to the highlight or the brief summary of the earnings call itself and what they're reporting on. Just a few highlights that I'm seeing right off the bat here. So we have total revenue increased 12% to 989 million, and that's for the quarter. So that's almost $1 billion quarter, which is a pretty good number to see. GAAP operating margin was down 14%, down 1 percentage point. If you're wondering about GAAP, it's generally accepted accounting principles or general accepted accounting principles, something along those lines. It's basically like how the government requires for you to report stuff. That's why a lot of times you'll see GAAP and non-GAAP measurements, because I believe it'll include things like depreciation, which isn't really a metric that we use in finance. You use that in accounting. Cash flow from operating activities was 336 million. Free cash flow is 316 million. So that is a good amount of cash flow running through this business. And on here, you'll also start to see things like their balance sheets sometimes and all of their other kind of financial information. I generally only take a quick look at this stuff. I think sometimes a lot of people put heavy emphasis onto this, where I'm more concerned about, is their revenue increasing? Is their cost of goods sold increasing or decreasing? That's a huge thing to pay attention to. And if they're not profitable yet as a company, does it at least look like over past few quarters or years that they're headed in that right direction? And if not, that's where I take a deeper look to see what might be causing that from them becoming profitable. So just a look here. So 3 months ending in April 30th of 2020, we could see their total subscription revenue was around, that 865.1. Then we have 966 for the 2021. So obviously their revenue is definitely headed in the right direction. That's something that we saw from that intro with one of the highlights. And I like seeing this. So I'm not exactly sure what this maintenance category is. That's something I'll probably want to look into. But I do like that the majority of their revenue is coming from a subscription base. I mean, significantly most of it's coming from a subscription base. And it looks like they're becoming less dependent here on this maintenance. So that's, again, I'm just curious what this maintenance is. Maybe it's something I could find in this earnings report. I'm not going to take the time during this video to do all of that research, but this is just kind of showing you the things that I'm looking out for. So this is something, again, that I would just be curious in, because as we can see, so the cost of subscription and maintenance revenue is increasing over time, which means ultimately the cost of revenue is increasing over time. So that's something, it's not always bad, because that could be expansions, acquisitions, or other things for them to make money, but it is something that I always like to look out for, because it could be a problem in the company. I'm assuming it's not, and then with 2020 being that interesting year, I'm also assuming that that might have played some kind of factor into the reason why their expenses have increased. But with all that said, despite the fact that the cost of revenue has increased, what's most important here is that their net income has increased as well. So as long as that's going up, that's a good thing to see. And from the look of this, I'm assuming they must have done some kind of recent purchase or acquisition or something along those lines, because as we could see, the marketable securities has gone down, as well as this cash and cash equivalents has decreased from January 31st, 2021 to April 30th, 2021. So during this quarter, that did go down. So that's something I would maybe take a mental note on, write it down on a piece of paper or something to look out for, is what is making this cash on hand decrease over time. Nonetheless, so just a quick level overview here. So their total current assets is 1505, and their total current liabilities is 3130. So that means just off the top of my head, that's probably a quick ratio of around 0.5, maybe actually even a little bit less, depending on if they use cash in that calculation. But again, just something, I know that these software companies are pretty expensive, but something to watch out for, because obviously we like for them to have money on hand as they grow in case they do need to raise more money, whether that's for other acquisitions, expansions, or paying off debts. And I'll admit here, so you see me going through a balance sheet, I can quickly go through this because I know what I'm looking out for, because I've spent a lot of time studying this stuff. And I'll admit, it's very helpful for you to understand where these ratios come from, because I think that ultimately helps you better understand how to interpret these different ratios. But you don't necessarily have to go through all this if you know what it means. So I'll quickly, again, take a run through this here. And then what I'll do is go through a website like Seeking Alpha to get further results, or simply Wall Street, which we'll do here in a second. All right, so this is their presentation. So this is obviously the material that they felt was the most important to point out during this presentation. So billings, 974 million, total revenue, 989 million. You guys can read all that. So here, it's just something I always like to look at is where's their revenue coming from, what's their biggest source. I'll admit I don't know what these numbers mean, so it's something that I'll have to look into, but we see AEC, whatever that is, seems to be their biggest source of revenue, and that was up 16% year over year, so it is growing in a good direction. And we can see that the Americas are still their largest source of business, which makes sense, this is an American-based company. Here's also where you get to see very kind of quickly or the bullet points of what the company is doing and how they're looking to grow. So we have accelerating digitization and AEC. Here we go. Here's the part that I was looking for. So acquisition of Upchain, a next generation manufacturing product data and lifecycle management platform, accelerated our strategy and enables further expansion into competitors' accounts and new verticals. So the acquisition of Upchain, I'm assuming that is probably what we saw earlier, where they started to have higher costs or didn't have as much cash on hand. What is Upchain? I don't know. Let's quickly find out. Okay, so this graphic here, again, I have ADD, so I do not like reading through a whole bunch of stuff. We can see that here's what Upchain is going to offer to Autodesk: customer management, project management, engineering management, product management, quality, manufacturing, supplier, design, business compliance, document control, change management, and dynamic workflow. So it seems like this is really almost going to be, I don't want to call it a CRM, they're calling it a PLM. I'm not exactly sure what that means. But as we could tell here, that it's obviously going to do a lot when it comes to working with the efficiencies of this company and making sure that they can run smoothly. It looks like it's a cloud-based platform as well. And I did quickly see there that it sounds like, I guess, cloud-to-cloud integrations work better than internal integrations. So hopefully this will be something that goes pretty smoothly for them, but I'm sure they'll face challenges when going through an integration of a new software. So now what I'm curious about is just how much are they paying for this? So it seems like Autodesk is really like a serial acquirer, because we could see that this is their 15th acquisition since 2017. Earlier this year, they made a $1 billion acquisition. So there goes some of the money on the balance sheet. And I don't see exactly how much they paid for Upchain. I'm sure it's something maybe that hasn't been released yet, or we'll be able to find out with just more time being into the search. But seeing that they already spent $1 billion this year on another acquisition makes sense to me why maybe their cash on hand has gone down. So at this point, I feel pretty comfortable with the general basis of this company. I understand that they do 3D modeling for architects, game studios, probably even some kind of movie studios and all that fun stuff. Reason why their cash on hand has gone down is because they make a lot of acquisitions, but they have been able to increase their revenues over the years, with their biggest source of revenue being from a subscription service, which is something that I like to see. And as we saw too, they don't just depend on their softwares for revenue. They also have other options, including a financing service. So that was pretty quickly. You know, obviously there's a lot more that I can dig into for this, but again, I'm going to keep this high level and not really worry about all those details, because you might know what AEC is, so I don't really want to take up your time looking into that stuff. So once I feel pretty comfortable with the general understanding of this company, what they've done recently, any big acquisitions or changes in the company, next what I like to do is compare their financials to their competitors. Again, 3D anything is an area that I love. I thought 3D printing would have taken off a lot bigger than it did. I was wrong, but that's okay. But I like to make sure when I'm not 100% sure on an area that I am looking at one of the better players, or at least a more financially sound investment in this space. And the best way for me to do that is to go to Seeking Alpha. Now, if you're not familiar with Seeking Alpha, I'll show you here. So we'll type in Autodesk. Right here, they have this peers option. And if you click on it, it gives you some competitors. Now, from what I'm seeing here, I do not agree with the fact that Autodesk is a competitor to Workday. Workday is like an internal management software system. I don't know, we use it at Vanguard, or DocuSign. So I don't think these are the ones that we should really be doing comparisons to, and that's why sometimes you'll see me not do a comparison, because while yes, these are application software companies or SaaS companies and they are in the IT space, I don't think they're exactly competitors with each other, even if some of their products might overlap with each other. So to do that, again, just a quick Google search for who is Autodesk's competitors. I should probably say who are Autodesk's competitors, but oh well. Bentley Systems, Ansys, Dassault Systems, and ESI Group. All right, so we already have the Dassault here. Let's clear some of these out. All right, so I'm fine with those three as the comparison for now. And again, remember, this isn't me doing this research to then go ahead and buy this stock. This is actually what I do to put it on a watch list so I can further do my research, but make sure I'm not wasting my time or filling up a watch list with a stock that I'll never end up buying. Last close. I don't like that Dassault is probably, since they don't have a last close, I'm assuming they're probably not listed on either the NASDAQ or the New York Stock Exchange. So just for simplicity, I'm going to take them out of here. Again, maybe not the best decision, but when I'm trying to go through this quickly, that's generally what I'll do, just so I don't have to keep going back and forth between exchanges and everything. All right, so looks like, what is this company? Bentley Systems has done much better than Autodesk over the past year, but looks like given that they don't have 1-year return, 3-year return, they are probably a new company to hit the public market, so we might not get the best information out of this either. Let's take a look here. Yes, so it looks like they went public in October of last year, maybe late September of last year. So probably not, again, the best company to be doing a comparison to, but we'll just stick with it for now. That is interesting too, to see that a company brand new to the markets is already paying a dividend. That probably has something to do with them being around since 1984, so that makes a little bit more sense. Remember, just because a company just hits the public markets does not mean they're a new company. They can be around for a very long time. Levi went public again, like 4 years ago or so, after not being public for the longest time, and we all know Levi's been around forever. And I'm sorry, I'm going through this here kind of quickly. So, as you can tell, I do not have a paid membership on this. I'm okay with that. Also, I thought this was interesting here. So Autodesk has a significantly larger market cap than Bentley Systems. Not really something I care too much about, but I would consider this to be more of a mid-cap company, and Autodesk is definitely pushing that larger cap company. So using just the standard PE gap ratio, again, this is what you see when you go to like Yahoo Finance and whatnot, and it says PE ratio. It's usually the PE 12 trillion months gap measurement ratio. And we have 53.77 and 114.83. So already I am liking Autodesk's valuation a little bit more than Bentley Systems, but those are both very high PE ratios nonetheless. Now, these are software companies, they are in a tech space, and SaaS is a huge industry right now, so don't expect to really find too many of these with the lowest PE ratios, but it's still something I want people to be cognizant of. And obviously from these EV to sales numbers, these are both very high numbers to see, so that's not the best. So from a valuation standpoint, both of these companies we're probably going to be paying a premium for. But that's where it helps, at least for me, understanding how are they making money, and is this something that's going to be sustainable over the long run? Because if a company has a great business model, I know they're not going to go out of business anytime soon and seems to be investing in the right places, then I could pay a little bit more of a premium for them because I look at that as I'm getting a premium service or a premium company. Now again, be cognizant of it because you don't want to overpay for something you don't have to. But if it's a good company, then, I mean, PE ratios can be easily manipulated by management. So that's a whole different conversation. But keep that in mind, PE ratio is just a loose guideline to get an idea of how the company looks from a valuation standpoint. The more important stuff to me here, though, is this growth. So revenue growth year over year is 15.76%, which is higher than Bentley Systems. Looking forward, it looks like Autodesk is still going to have a stronger revenue growth than Bentley Systems according to analyst estimates, so that's okay with me. EBITDA growth is fantastic. The earnings before interest, taxes, depreciation, amortization, 58.65% is huge, and it's double what Bentley is doing. So they're doing a great job, as we saw earlier from that earnings report, with their cash flow. And that's a really high ROE, 292.40. Remember, that's not always like a great thing to see it being that high. I don't think it'll discourage investors when it's that high, but that could be a one-off situation or some kind of outlier number in there that is giving them that really high ROE. And just for the fun of it, we could see if we've held on to Autodesk for 5 years, we would have returned about 383%, which is a pretty solid return. All right, and then what I always like to do here, all right, so I was pretty off there on their quick ratio, or they're on their quick and current ratios. I do like Bentley Systems' quick and current ratios a lot more than I like Autodesk, but this is more encouraging than I thought it was. Again, just doing that number off the top of my head, I had around a 0.5. It's actually around 0.83 or 0.77 between those two. So not terrible. And again, with this company making so many acquisitions, I do expect that number to be lower, and it makes sense to me now why that number is lower. So I hope you got to understand that process for this. So lastly, what I'll do here is I just kind of double check everything with Simply Wall Street, because the reason why I like Simply Wall Street so much is, well, as I've been saying, it's easy to follow along with. It's lots of pictures and colors, so it catches my interest enough. And I think they do a great job of targeting things that are actually important, but eliminating some of the clutter that you don't really need to worry about. So as we can see here, I'm on Simply Wall Street. Again, I don't know if I just said this. This is a paid service, but if you are in the market for a paid service, this is the only one I've ever used, but I love this one. I've used not millions, but I've used a ton of different investing things, apps, services, programs, whatever, to kind of do my research. And I really have found that Simply Wall Street is my favorite one. They don't sponsor me. I wish they did. That'd be super cool. But that's just my honest feedback about this software, website, whatever. So check it out. It's simplywall.st for their website if you ever want to use it. I think you get a few free stocks to look at and try it out. But as we can see here, they do say earnings are forecast to grow 25%, good to see, and their earnings grew by 325.1% over the past year, which is crazy. Another thing, I think I've said this before about Simply Wall Street that I like, is this little snowflake model that they use. Just because if you're looking for a stock that is like a value stock with strong health, you can actually draw that out on this snowflake and it'll show you companies that meet that criteria. And that's funny too, they actually list Adobe as a competitor. That's who I said earlier they kind of remind me of. So being a long-term investor, I don't really care about this like 7-day return. That doesn't really matter too much for me. Even a 1-year return, I could take it or leave it. It is worth pointing out that in the past year, it has not returned as well as other software companies or as the US market, meaning to me that this might not be the highest growth opportunity in this space. Now, this is the part that I really like. I used to do these metrics when I first started Watchlist Wednesday, the discounted cash flow analysis, and that just took so long to do because it's a projection, you have to run estimates, you have to calculate like weighted average cost of capital, and it's just not really the most fun thing to do. Where Simply Wall Street literally takes the same process, you can even view the data. Discounted cash flow, yeah, they use the discounted rate, leverage cash flow, perpetual growth rates, all that fun stuff. As you can tell already, that's why I did not really enjoy doing that part of the Watchlist Wednesdays, and I just rely on Simply Wall Street now. And it shows you all of this stuff too, in case you were curious on how that's actually calculated. I would never do it this way. I would do it on a spreadsheet, but that is pretty similar to what my formulas would look like on a spreadsheet. So 1.7% overvalued here. again, using a cash flow. Now, that's not really a guarantee that that's what the price is worth, but I like discounted cash flow because I think it really does help paint an accurate picture for what the company could be worth. And seeing it's only 1.7% overvalued does not really concern me, considering that they're expected to have that 25% plus growth rate in the future. So I'm okay with that right now. If it were to be, I would say, exceeding like 15% overvalued, then I would probably stay away from this. And sometimes we get lucky and see stocks that are like 50% undervalued. So, you know, pick and choose your battles, and it's up to you to really find what you're most comfortable with. So this is interesting. Their PE ratio is not the same. We could go through and calculate it ourselves if we really wanted to make sure we have an accurate one, but you know, again, take everything here with a grain of salt. When in doubt, you can always just double check with Yahoo Finance and see which one seems to be the more accurate one. But based on what we have here, this could also actually be, having to do with their earnings report coming out yesterday, where simply Wall Street might not have updated it yet, where Seeking Alpha did. And that could just be why we're seeing a difference here in the PE ratios. But PE of 48.5 compared to the software industry at 47.9, looking at it that way, I think really helps understand that this company might not be terribly overvalued, because we're less than 1 times off with the price to earnings ratio from what the market is doing or what that sector is doing. And also we're like 1.7% overvalued. So this company might not have as frothy of a valuation as some of those other metrics try to tell you. And then this is the part that I like to see here. So we have the company's future growth versus the industry and the market. That 25% is obviously much better than the industry and the market. So that's something that I do like to see if I plan on holding on to this for the long term. This future ROE is crazy though. 50.4% to the industry's 13%, so that's another good thing for me to see. The past, that's okay. Obviously, they've had very strong earnings growth in the past year, which is, again, great to see. There was no reason we should complain about that. And then this is what's a little concerning to me. As we could see, their short-term assets, so that's anything really you could pay cash for or use as like a cash payment, does not cover their liabilities well at all. And again, we know they're making acquisitions here. They do have a lot of long-term assets, but that's not as great to see. So that is really the one thing that's coming up to me with a little apprehension of investing in this, is the fact that they have a lot of debt on their balance sheet, and also that they are, I guess, fairly valued, but I like to look for that little bit of undervalued stocks, so that way I have just a little bit better chances of a growth opportunity. And no, value and growth are not the same thing, I know, but again, bear with me here. And last thing I really like to take a look at here is the ownership. So 89.5% is owned by institutionals compared to everything else. General public makes up 10%, and then you can see the rest is less than 0.1% ownership, which again is something I just like to see, because when an institution like as we could see, BlackRock, Vanguard, Capital Research, State Street, Holland Capital, that's a horrible name. Anyway, as you can see, as these people put this stock into their funds, that generally means that it's going to help cut down or reduce the amount of trading volatility or trading volumes with it, which helps tend to stabilize the price of a stock, which is something I like, because as I said in, I think that was 2 videos ago now, when you have a specific investment objective that you're saving for, and you know you're approaching these times that you'll need to access the money, the last thing you want is a heavily volatile stock, because that could be the difference of you making or not making your investment goal. So that's again why I like to see who owns this company and how much is owned by institutions.
And then from there, I just add it to my watch list, as you guys see me do every week. So some other watch lists, in case you don't know, if you want to try doing this on your own, I use Webull every week. I've also used E-Trade. You could track these on Apple Sheets, I think they call it, or Apple Numbers. Investopedia has one. E-Trade has a paper trading. So I like the paper trading as a watch list because I get to see how that's been performing. You know why I do that. So that is how I review stocks. I'm going to wrap up quickly here. My camera's almost dead. I want to make sure I finish, but I hope this was helpful. I know I left out some details. I know this wasn't really like the most accurate way of looking through stocks. It was pretty high level, but please let me know any questions you have for me below. If there's any metrics you like to look out for, or anything you think I should maybe be looking out for or spending more time focusing on, any of that, leave that down below. Anyway, I'm going to wrap up here. Remember, like this video, 5-cent donation for charity, subscribe, 10-cent donation for charity. Yeah, that's about it. So it's a nice day. Hope everybody has a great weekend. I'm going to wrap up here. So thank you so much for taking the time out of your day to watch this. You could be anywhere in the world, but you're right here with me. And I really appreciate that. I'll let you go ahead, enjoy the rest of your day, and I'll see you next week.